Well, hello everyone. Very exciting. Charles here as always, and we're going to look at basically company historical financials and how to do it for an investor. And this is not financial advice. I don't give any financial advice. This is just entertainment. So, sit back and be entertained basically. We're going to look at mining, one of my favorite companies. We're going to look at an energy company, Australian Gas Light, and we're going to look at a bank, ANZ, Australian New Zealand Group Holdings Limited, and we're going to see from the perspective of an investor how you might want to look at historical financials in order to see how to invest. And I don't like things like Google, Yahoo Finance. You don't see what the investor needs to see. That's the problem. You want to see it. You want to see what the investor needs per share. You want to know what's going on per share. That's the only way you're going to be able to, in a way, predict the future if you're a long-term holder. Obviously, lots of traders, they don't care about any of this. They're just trading it one way or another. I used to try doing that. I would make one good trade, then I'd wait, then I'd make another good trade. I wouldn't use any margin. Honestly, trading, not worth it for most people. Just buy something that's growing. That's all you need to do. So BHP, one of my favorite companies. Let's look at what's going on. Let's look at how to analyze it. And you basically need something like CommSec, something which is going to give you historical financials. So let's get into it. So BHP Group Limited, it's got all these bits of data here. We don't need to know, none of this tells us very much. We don't need to know any of this. It's got the market volume, the market data, the depth it's called, what's going on, the buyers and the sellers. It's got the price, it's got the volume, when the volume increases, and all this, and it might do this or it might do that. That's what the traders are into. They're currently saying they're currently see, and this is what the experts are saying. It's a buy, it's a sell, it's okay, it's a hold. You see, they're actually not quite sure. Price to earnings at 9. Okay, now we're starting to get something which is quite useful actually. So the price to earnings are 9, so it's less than 10. So you'd call that a value stock. Now we're getting into some interesting information. Earnings per share is 6.11. That gives us the price to earnings. But what does that tell? That doesn't tell us anything in itself except for the value. How big it is on the share market doesn't matter. We just stick to big shares, big companies. Debt to equity doesn't really matter. Price to book doesn't really matter. 5-year doesn't really matter. I'll start to show you what matters. And from my perspective, for a long-term hold. So to do that, we need to go into the historical financials. So what we do, we just go here, financials. Okay, what's going on? Okay, here we go. And this is it. This is where you get all the information if you want to try and be a bit of a Warren Buffett and try and be a bit of a bit of a holder. So we're going to look at some things that you basically need to look at. So this is per share. And because it's per share, whatever this is doing in the long term, your share is going to do that too. So now we've hit solid gold. This is where we need to be. Don't look at the noise, look at where we need to be. So for Australians, it's a fully franked dividend, which means you declare it on the tax. And then you get a tax offset based on that because to avoid double taxation for your dividend. And what we often like to do, if it's a holding company, like say an investment company, we would look at book value per share. We would want that to be expanding. In a mining company, maybe it doesn't matter that much. What we really want is earnings per share. And earnings per share is one of the most useful tools you can look at because this shows us what the stock price is going to do, where it's going to be roughly in that year. So in 2014, you were earning $2.16 a share. In 2015, you were earning $1.61 a share. So you would actually expect the share price. And if you look at the chart, you will see it will surely decrease between 2014 and 2015. And that is just what happened. It went up. And as you see, the long-term trend is that the earnings per share are actually increasing, which is quite nice to see. Very nice to see. And if you look at a chart, like you look at a chart, this is earnings per share. Look at a chart, a long-term chart, not a chart of the actual stock price. You should see that earnings per share reflected in the stock price. So what we're going to do, we're going to look at a 10-year chart, and we're going to go back to 2014, 2015. And as you see, between 2014 and 2015, when it went from $2 to $1.60 a share earnings per share, the stock price went from $30 to $25. Damn, that was cheap. That was really cheap. I knew it was cheap, but I didn't buy. Yeah, that was quite cheap. That was good. That would have been great. That would have been fantastic. But this is a fantastic company. Even at these prices, I have to say it's not a bad price at all. But that is not advice. Don't take any advice from me. This is entertainment, okay? That's my disclaimer. So you can see that the earnings per share is actually reflected directly in the stock price. So let's go back to the financials. Hang on, financials, right? So what else are we looking at? We see earnings per share. So earnings per share is now increasing, and we see that massively in the share price. It's going up quite a lot. We want dividends per share to increase as well, because we want to have a profit. That's important. So dividends per share, yes, they're going up. Shares outstanding. Now, if the company is inflating its shares too much, that's the same as inflation in the market. But we actually see that the number of shares outstanding have reduced. And that's partly responsible for the earnings per share increasing, because there have obviously been some kind of buybacks, which is excellent. Another excellent thing about this company, they release stock in other companies. We recently got a split. They recently combined their oil business into Woodside, which is Aussie's biggest oil business, and gave those Woodside shares out as a bonus to shareholders. They've given other bonuses. BlueScope Steel shares were spun off. Their steel business was spun off. They also spun off some of their lesser performing mines into South32, another spin-off. You want companies that give you spin-offs over long term. So let's look at, I don't think you can do financials for more than 10 years with this software, but basically that's kind of all you need. So let's look at what's really important as well, the return on equity. Generally, we want companies with a return on equity more than 15%. That means the money that's given to them, how much percent are they going to earn on it? And as you see, they're earning quite high interest on their money. That means they're doing a fantastic job. And return on equity, that's the return on equity there, rather than the return on equity rather than the return on capital. But look, they're a similar measure. As you see, they kind of follow each other. So you may as well look at one or the other. I know Warren Buffett says return on equity is more useful than return on capital for investing. That is possible. Net gearing, it shows you how much debt they've had. Look, they had no debt, or the money's not available. The finances are not available for those years. How many employees? In thousands. For some reason, it's not available for this year yet. The market capitalization, what's it worth on the share market? So it's worth a lot. It's worth quite a lot. Shareholders' equity in millions. How much do shareholders own? Long-term debt. Long-term debt is reducing. That's a great sign. Great sign. That means more money can go to, and that's excellent in today's that they've done that. In today's market, that they've reduced the debt because interest rates are now coming up, as we all know. So this company will perform, I hope. Relative price to earnings ratio. Don't worry too much about that. Annual price to earnings ratio. Don't worry too much about that. What you're basically looking for is the earnings per share increasing over the years. You want the dividends going up. And you want a good, strong return on equity that shows you the quality of the management as well. That's an indication of the quality of the management. And that is what you want to look for for a long-term hold. So that's a good company. And by the way, what's it done? Okay, let me tell you a little secret. I had this company at $10. Let's look at the biggest chart. I had it at $10 just before the Iraq War. It went to $8.50, and then I had it there. It went down to $8.50, as you see, and when it went back up, I just sold it. I thought, stuff it, I'm selling. And then if I had kept it, I would have increased the money 4.5 times plus dividends, which would be many more times, plus the spin-offs, which would be many more times. I would have been rich if I'd kept it. So a company that is performing like this might be a company that's something you want to keep for a long time. But of course, this is not advice. I'm not giving any advice. This is entertainment. Okay. Let's look at the next company, AG. So now we're going to look at, and obviously mining companies, I like them at the moment because they're actually good in an inflationary environment. Okay, let's go to the next one, AGL Energy. This is Australian Gaslight Energy. As you can tell, it's probably from the old days. Quite interesting. So there was recently a takeover bid because the share price collapsed because of some kind of restructure. So let's look at what happened with the chart, and that's reflected in the chart as well. So we go down to the max. Let's look at the max chart. So I used to own this stock back when it was like $15. 2008. I used to trade this up and down. It didn't move much. Utilities don't move that much. They tend to be more boring companies, lower margins as well than mining companies, than huge mining companies. If you go for mining, go for a big one. And as you see, this is what happened. Then it went up to $25. So it was like, oh, it was a stellar performer, but nah. Oh, what's happened? It's in the doldrums. What's happened? What's gone on? We're going to look at the finances to try and decipher what's happened. There was even I think there was an attempted takeover bid. I'm not sure what happened there. The Atlassian boss in Australia, he thought, well, this is cheap. His investment banker must have told him, hey, let's buy. About the same time that Musk was buying, there was a bit of a tech wreck. At the same time that Musk was buying Twitter. And it's still in wreck territory. What's going on with that? Why did it do that? Why did it go up so much 2015 and 2017? Why did it go down again? We're going to see that in the financials. So let's look at the financials. Whoops. Let's go to the financials. So what's happening here? 2015 to 17. Earnings per share decreased. Oh, what happened? Was there a stock split? So let's look at shares outstanding. No, there was no. We didn't dilute the shares. What's going on? Okay, so earnings per share actually went down 2015 to 2017, but dividends went up. The dividends increased. So they were paying out a huge dividend, maybe over and above what they were earning. They might have been paying that out of the debt. So that shows us, okay, that might have made the share price more attractive to shareholders. And then it really went up. The dividends really went up. They increased a lot up to 2019. And after that time, we start to see a collapse in the price. And we see the dividends per share going down a lot. And we see the earnings per share went up from a high of 242. It just kept going lower and lower. It went from a stellar performer and it went lower and lower. And look, a loss. That's why it collapsed. That's not a good thing. That's not something you want to see in a utility company. And now it's coming. It's actually come back up a bit. The shares could be in value territory. There might be a value play here. You see, and they've diluted the shares a bit because something's happening. So they've issued a few more shares. Instead of issuing debt, you can just issue more shares, sell them to investors, institutional or retail, which is the public. And that seems to be what has occurred. Let's look at what happened to the quality of the management. That's the return on equity. So they were making pretty ordinary return on equities as a utility company does. Boom, they had a huge return on equity in 2018. So that's probably what dragged the price up. And then it went down. So the return on equity went back to 11, which is back to mediocre territory. 12 is all right. But then look at that. Oh my goodness. They lost money. They lost 4.7% on all the money they had. Now it's back to 18% return on equity, but the market is skeptical now because the market has been burned. It might be a value play. But again, this is not financial advice. I don't give any financial advice. Look, there's a double dip. That might be a play, but I'm not going to say anything, okay? I don't say anything on this channel because, I have some enemies out there that don't like me, so I have to be careful what I say. So that's AGL. And by the way, how much is the dividend? We want to know what the dividend is. Okay, it's 3.1%. That's not too bad. You can get more in the thing is now with more increasing interest rates, you can get more in the bank. Why would you want to take a risk with something that's going up and down like a yo-yo? Then again, it's cheap. And this company's over 100 years old, so you gotta weigh up all these things, up and down. Anyway. So let's look at the next company, ANZ Group Holdings. So this is a company that I bought it back in the early 2000s for $27. I sold. Eventually, it went up to 35, 37. I didn't sell it, and then I sold it at 28. So I made a little bit of money. I had it for about 10 years, and I made almost no money. I just made the dividends on it, just a long-term hold. I have to tell you, this is one of those companies that doesn't do much for shareholders, actually. Look at that. Look, honestly. What are they doing? And you've got to ask, what are they doing for shareholders? What are they doing? Okay, we have to go all the way back to 94. They were $5. Ooh, the wedge. So this will either shoot up or shoot down. So something's happening. Something's about to happen. Okay, are we going to go into recession? What's going to happen? That's a huge wedge. It's going to shoot up or shoot down. Wow. Wow. Okay. Look, it's not badly priced, I have to say. It could go either way, Cost of living crisis, who knows what's going to happen? I don't see it shooting up. Cost of living crisis, I don't know. Damn, that's interesting. Anyway, I had it when it was around around here, these prices. And I sold it for a slight profit. And I used to trade this up and down all the time. I'd make $200 here, $400 there. But anyway, it's a bank, it's a big bank. What's it doing for shareholders? Honestly, if you had it in 2006, it's done basically nothing for you. Meanwhile, inflation has increased so much and compounded your money. So if you had it there, you sold it there, apart from the dividends, you've lost money. Let's look at the financials, shall we? Let's see why it's so mediocre, basically. So book value per share, it's not changing much. Earnings per share, it's not changing much. That explains it. The earnings per share, look, it's gone from 260 to 230. The earnings per share don't change much, so it's pretty flat. The dividends, $1.77 to $1.46. Oops. Let's look at the quality of management. It's a bit low. It's a bit for a big. Yeah, there used to be these like 15% return on equity when it was higher. So whatever the return on equity, it'll be priced higher on the chart if there's higher quality management. So here they're only making like a 10% on your money. Look, it's not bad, but it's only 10%. You may as well. You might get more in real estate. Maybe you might get more. So. And most of this is going to salaries anyway, so it's obviously not being transmitted to the shareholders. Show me how it's being transmitted to the shareholders. How is that all that 10% compounding a year being transported to the shareholders? And the answer is that it isn't. They're just getting the 4.5% dividend or whatever it is, and that's it. So it's not much growth, not much compounding at all. Let's look at the payout ratio. So this is interesting. So when we look at the payout ratio, we'll see how much they're keeping for compounding purposes or whatever purposes. How much of that profit they're keeping. So payouts. Oh, where is it? Where is the payout ratio? I don't know. Sales, cash flow, earnings, dividends, franking, total return. I don't know. Shareholders' equity. What happens to the payout ratio? Don't know. Haven't looked at this for a while, but anyway, there we go. Can't find the payout ratio. But that would be important to know as well, because we'd want to know how much of the profits are being paid out as the dividend. And generally, it's good if the company keeps some for compounding purposes. Otherwise, how are your shares going to grow? If they're paying it all out as dividends, how are your shares and salaries? How are your shares going to grow? Anyway, so that's Australian banks do well compared to world banks, but it's still kind of mediocre, isn't it? So if you want a long-term investment, you want something that's really compounding the earnings per share. You want something that earns a lot of money, the return on equity, and you want something with not too much debt. You want a great business, basically. Shares outstanding haven't changed much. They always increase a bit due to the dividend reinvestment plans. Yeah, look, it's an interesting company. Yeah, book values are useful for banks. 17. It's increasing, but then again, inflation's increasing as well. So of course, it's going to go up. Fascinating stuff. Fascinating stuff. So, I'm showing you basically a basic way of looking at financials for long-term investing. So I hope you've enjoyed this video, and you might want to apply some lessons in your own life. It's not financial advice. This is just, just investing. Just this is the Charles Investing Club. Cheers. And of course, by the way, I'm also a broker. So, in mortgages. So, if you want some assistance in that, I'm very happy to help as well. So, hit me up.